So this 2021 year is a bit like coming of age, whereby this is where the whole market will actually come together, get the act together, get writing the business more on the disciplined basis, and try to make turn the market into profitable again.
Hi guys, today we're going to talk about cyber reinsurance. Now, as we know, reinsurance is as important as primary insurance. This is why I'm super happy to invite to the program today Sie Lau, who is the head of provisions and cyber for SCOR at the London market at Lloyd's. Now, the Lloyd's market is of course the most important insurance market in the world, and therefore we will not only talk about the way standard reinsurance and cyber reinsurance works, but also what the sentiment towards cyber is now that in 2020 and the beginning of 2021 the cyber damages have skyrocketed. So let's welcome to the program Sie Lau. Welcome.
Hi, morning, Daniel, or evening from my side. I'm actually in Malaysia right now. Normally, I'm based in London. For family reasons, I have to travel out during COVID, which is very much unfortunate, but I mean, it's a journey I have to make. Yeah. So thanks for having me.
Of course. Thank you so much for joining us, especially now that you're abroad. Let's dive right into it. There are two different basic types of reinsurance. One of them is facultative, and the other one is treaty insurance. Could you tell us the difference between them?
Treaties are essentially agreements that cover broad groups of policies. Facultative, on the other hand, is mainly covering a specific individual, generally high value or hazardous risk. Within treaty, you have two types. So excess of loss reinsurance is a type whereby the reinsurer would indemnify or compensate the ceding company of losses exceeding a specific limit. Um, so normally the ceding company would agree to accept all losses up to the predetermined level, which is what we call the attachment point. And the other aspect of the treaty reinsurance would be quota share, whereby it's a pro rata reinsurance in which insurer and reinsurer they will share premiums and losses normally according to a fixed percentage. Quota share would allow the insurer to retain some risk and also premium while sharing the rest with an insurer, also up to a predetermined maximum coverage.
I see. So when we talk about cyber, is one of these types more prevalent than the other one?
So quota share is still predominantly the most popular way of ceding cyber risk away to reinsurer. So I would say, based on my observation of the market, currently we are talking about 70 to 80% quota share, 20 to 30% non-proportional, which is normally in the form of aggregate stop loss for cyber risk.
It seems that it's always presented as a complete symmetric agreement, where, for example, a reinsurer takes like a quarter, like 25% of a given insurance book, and then it basically covers the losses if there are losses, or takes the profit if there are profits. Are there like some kind of kickbacks or other, let's say, additional agreements?
Yeah, I mean, normally the reinsurer will have to cover, I mean, the overhead on the reinsurer side because of the distribution cost that reinsurer will also pay some so-called overrider or overriding commission is really helping the insurer to offset the cost that they actually incur when they are selling the products.
I see. Okay, so it's, let's say in broad terms, it's a symmetric agreement with like some additional ways for the party who has higher, let's say, variable costs associated with getting the insurance book to be compensated.
That's correct. I mean, normally because it's the follow the fortune type contracts, in the event that the let's say that the business turn out to be very profitable, there would be another incentive in terms of in the form of profit commissions, whereby the insurer will be able to get some of those back, but normally after 3 to 4 years time, and in the event whereby there are losses that's I mean incurred, I mean which is more than expected, turn out to be loss making, for instance, those won't be payable, and it will normally be offset for future years as well. Meaning, let's say the coming year, treaty year, whereby they are still making profit, but because prior years there are losses, then the losses will be used to offset the profit commission, for instance.
I see. Okay, very interesting. So there's additional
Mhm.
incentives, for example, for the primary insurer or for every party actually to do their best and to make sure that the loss ratio stays as low as possible and that the book, grows as fast as possible at the same time.
I mean, in the perfect situation would be profit making for both sides of the world so that they're all going to benefit from this arrangement. Equally, the insurer will be able to write more business as a result of the quota share arrangement, given the fact that they have more capacity at hand in order to reach out to write more business, for instance.
During 2020, during the COVID pandemic, the cyber damages have skyrocketed. Especially ransomware seems to be a growing concern for insurers, causing even higher damages than what many feared. Chubb, the biggest insurer for cyber in the US after portfolio size, for example, has increased cyber insurance premiums by as much as 50% and has introduced co-payments on the ransomware part of the cyber insurance policies. So, Z, being in London, the most important market for reinsurance in the world, what have you seen in the last year during COVID with regards to cyber? And what is the current sentiment for cyber in the near future?
Even prior to COVID, actually, we have already observed the ransomware events uptake even back in 2019. So amid COVID is essentially escalating the kind of activities that we see in the cyber world because they are using COVID like as a way to fish information, and also there are seem to be more incidences due to business email compromise incidents, for example. So hence, even back in, I mean, throughout the 2020, we were already seeing corrections. Underlying rates were already up. Initially in the high single digit in the first half of 2020, towards the Q3 and Q4, we start seeing like in the teens, and then basically double digits starting from teens in Q3, and then in the 20s in Q4, and now we are talking about like you alluded just now about Chubb. Just I think they mentioned in the press in the recent few weeks that they expect the risk-adjusted rate change for the whole cyber portfolio actually is about 42.5%, with 50% and above for the large corporate risk, and of course also in the region of double digits, lower double digits for the smaller SME business. So this is not just for Chubb. In fact, we are hearing this kind of sentiment for AIG, for example. They just recently announced that they expect the rate change for 2021 to be at least 20 to 30%. Beazley is the same. They're talking about minimum 20%, even up to 50 in some uh, cases. So what we're seeing here at the moment is the sentiment has been evolving as you know on the weekly basis, especially running up to the year end 2020 because of the SolarWinds incidents as well, and it has really dislocated the market quite a bit. A lot more questions asked about whether there are actually adequate internal controls on the cybersecurity fund of the insurer that have put in place. When they do the underwriting part, they want to make sure there are more stringent underwriting prerequisites, including they would be demanding like making sure all the remote desktop protocol accesses like must be all closed, for example. They would definitely have the kind of like multi-factor authentication or MFA or even single sign-on measures to be in place, for example, and security scanning using the kind of like tech vendor like CrowdStrike or CyberScout. And this is normally for large corporate risks and now has been extended even to the small medium enterprise, for example.
You have mentioned a lot of factors that the primary underwriters are looking for when they're now signing new business in cyber. What are you as reinsurers are looking for when you're looking at a potential book of insurance that you want to reinsure?
We are still seeing quite a lot of new opportunities, for example. So one thing that we definitely need to look into in terms of due diligence process would be looking at the client's underwriting resources. We
Mm-hmm.
want to check whether the actually underlying product is actually underwritten by a dedicated team, whether there's a cyber team within the insurance operations, um, and also the experience, of course, of the underwriters in the cyber risk. I mean, even though we are still talking about 20 years max in terms of the longest you can hear about experience in underwriting of cyber risk, majority typically would be at most likely like up to 5 years. So even that 5 years experience would be quite key for us in terms of having the kind of experience that we need in order to give us the comfort when it comes to the underwriting of cyber risk. Of course, we also need to understand whether they actually drafted in any cybersecurity partnership in the development of the product, who they are partnering with, the tech vendor they are using, and the kind of advice in terms of risk assessment that they have working together in the sense. Because again, cyber risk in terms of cyber insurance is not that similar to the sense of like property insurance or other insurance product, whereby it's not just about providing the limit. I guess it's about a more 360 type service. As a reinsurer, we would like to know what the kind of maximum policy limit the insurers are offering, and that this would varies from whether they are writing small, medium enterprise type risk, the kind of micro SME we are talking about here, maybe 500K to 1 million, to maybe even up to 25 million for large corporate risk. And of course, would be the client's underwriting philosophy, because we wanted to understand whether what portfolio they are focusing on, whether it's SME, again, large corporate or industrial, and what part of the business they're focusing in terms of regional exposure, whether it's US based or non-US based, uh, whether they're focusing mainly third party, or whether they also have a clear coverage including first and third party, for example. I mean, as separate risks. Also, we will need to understand, we will definitely ask for their policy wordings, and also the underwriting form, the proposal form.
Another thing that interests me is the economic of scales in reinsurance. So a minimum book size that that has to be a necessity before you even look at underwriting a portfolio. So for example, if they only have like 10 policies with maybe premiums of 100,000, I would assume that for somebody like SCOR, as one of the biggest reinsurers in the world, this book is too small to actually look into.
Terms we use is balance, because I mean, if you offer a certain limit per policy, um, let's say 10 million, if you're only writing 10 policies, 100K each, so for the 10 policy you only get a million. Let's say if there's a total loss for one policy, that would be 10 million, but you only have 1 million to pay for it. So in that sense, it's very imbalanced. And then essentially what we're looking at is, of course, the number of limits that we have seen, and hence for insurer, that's also mean the insurer, they also need not just the quota share, they need the non-proportional reinsurance to help them to take away the volatility part of the losses as well, in order so that they are able to write when there's a sudden full limit loss.
How does the reinsurance process look operatively? So for example, you are the head of cyber at Lloyd's for SCOR. How often, for example, do you have people knocking at the door? And so basically, how does the due diligence process look like from an operative level?
You get a lot of submissions, especially in the recent year end. I mean, recent one, mainly because I guess a lot of the insurers are quite nervous about getting the capacity they need. But in terms of how we operate SCOR, we have a certain risk appetite we set out from the beginning, and we also quite clear in terms of the target type of business that we wanted to write. And it would be essentially, as a global reinsurer, our target will always be as more like looking as a service for our clients. So if our clients are extending this type of class of business as their extended offering, then we will look to support, of course. But now we are extending to a point we have to start looking more all this reinsurance opportunity as a standalone kind of like merits on its own. So they need to be profitable. They need to be able to scale it to a point that are able to generate diversification for us as well, in the sense of, let's say, if your exposure, we have plenty of exposure in US, which is common given the fact that majority of cyber risks are still derived from the US market at the moment. We would like to build on other part of the world whereby we haven't seen many yet. For example, in Europe, whereby we would be able to balance the book a bit. So, and in addition to that, the type of underlying business that they write, as mentioned earlier, about whether the insurers are focusing more on the small business or whether they're targeting large corporate, or whether there's even a balance between the two. So at this juncture, I could say we are still quite nervous about the cyber risk directions heading in terms of the evolution with the recent losses as well. So we are actually still not going big at the moment, but we're trying to be carefully, selectively supporting those that we wanted to support because they are our key clients, and those that we support because we believe in supporting, because we believe that the portfolio they are developing are the right one for us, for example.
Would you say it's a fair statement that given the same number of premiums that the primary insurer as well as the reinsurer currently definitely prefers small and medium enterprises to large ones?
What we are seeing at the moment is still less in terms of targeted losses due to ransomware, but we are still seeing the number of ransomware being on the up, but at least not as targeted as some of the large corporate risks that we have seen today, for example. Also, in terms of, because of the size of the company is all linked to the revenue as well. So smaller the company, let's say the SME, whereby their revenue may be less than 100 million, it is becoming less of a target for the cyber criminals, for example. But on the other hand, um, you have this latest ransomware as a service. It becoming so easy now to actually deploy a ransomware by a lay person, for example. You don't need to be a tech expert on that kind of like deployments, and then it's becoming so easy now that you become the kind of like big game hunter that they go out there and randomly, asking for ransom by maybe just deploying some of this malware to any sizes in terms of any organization, for example. So we still need to be very careful in the uptick that we have seen, because small medium enterprise in the past has been very profitable with very low loss ratio, and even now they are still kind of like low loss ratio. We're talking about 10 to 20 points more increase in terms of loss ratio is already a loss making easily for that particular portfolio book of business, mainly because for small medium enterprise usually they are low limit, low premium, but also equally high maintenance. So the cost of distributing is usually on the high side. So you could easily see 30 to 40% of the premium would be actually used just to pay for the distribution, the marketing, and the deployment of the tech vendors, the cost for even providing incidents pre and post support, for example. Um, so, so the balance here is really the key now is really correction maybe in terms of the rates, because already in the markets we are talking about rates that will still go up more this year 2021, and they are talk about the rate going up would be more than any of the other classes that we see this year, and they were also talking about multi-year correction, meaning this year and next year and even the year after. So so for us, that we have to tread this carefully in the sense that we are focusing on SME, but at the same time, we have to make sure that more additional underwriting criteria, as mentioned earlier, are actually being put in place. More questionnaires around cybersecurity measures, those patches are being put in place, especially after SolarWinds. We want to know whether they are using that Orient software, for example, whether we will also need to understand whether the insurers are look to even exclude that if they are being, because we still don't know what it means in terms of that event, whether there will be more losses coming through due to the third-party liability side, whether it's associated with the CBI side, we have no idea yet. 2021 year is a bit like what Insurance Insider mentioned maybe last month, coming of age, whereby this is where the whole market will actually come together, get the act together, get writing the business more on the disciplined basis, and try to turn the market into profitable again. Because based on the feedback, on the observation to date, 2019 year and 2020 year would be both loss-making year for the London market carriers, for example.
Reinsurers, especially in cyber, are also somewhat of the sheriff in town when it comes to, making sure that the rules are followed, that the underwriting guidelines are sensible and are adhered to on the primary level. Would you say this is a fair characterization of the role of reinsurers on an operative level?
They are in a way that dictating how insurers should shape the policy wordings, and also how they should focusing on the kind of like the questions they need to ask, and also to the kind of like risk they are able to write, for example. So that is to a certain extent is correct, but on the other extent indirectly is correct in the sense that because insurers, in order to write more cyber risk, I think when they start growing, because of the uncertainty around the exposure and the kind of like accumulation, so they won't be able to write as much without the support of the reinsurer to take away some of the volatility on the top bit of the exposure. Cyber, unlike casualty, is not really long tail. With the ransomware events, it's quite short tail. It's actually immediate. We know straight away when there's an attack. We know quite straight away the exposure. It's a case of how likely that turn into actual losses. That may take some more time. But in effect, so long we know the event straight away, the markets are already reacting to it straight away. We're talking about losses due to 2019, 2020 years, but in 2020 year, we're already seeing corrections. For example, back in 2019, we were still hearing negative rate territory. Rate are coming down, were coming down, and now in 2020, we were already hearing rates are not coming down initially, from not coming down to single digit increase and then to double, now to like talking about 25 as a minimum, and now in 2021 they say it will even be more. So that is the good sign in a way, that because although there are many activities due to ransomware, markets should take care of it and correct itself to the point that ultimately there would be enough premiums to pay for it. The question mark would be it could become too expensive.
Thank you so much for all the information you have provided us already. So, in summary, what do you think, and of course you already have given partial answers to this, but what do you think is like the, let's say, top 3 or 4 developments that we will see up to, let's say, 2025 in the cyber market in general, and then perhaps also particularly in cyber reinsurance?
Yeah, definitely the growth is definitely still there. We will definitely see more double-digit rate rises. Not sure about 5 years, but would be at least for the next 2 years. We are seeing capacity decreasing, definitely. Smaller deploy lines across all the carriers that we have discussion with, for example. And also the focus are also on primary layers, for example, for the mid to large size accounts. We're talking about at least the mid markets here with revenue 100 million and above, for example, and how they are actually reassessing the line sizes and the attachment points. Essentially, all the carriers are at the moment are correcting the way they underwrite, and hopefully they can rectify the underperformance. And also, the competition are still pretty much there at the moment, but I guess ultimately is how quickly that the carrier, the insurers, are able to work together with the tech vendors to come up with ways to prevent quickly and in a timely manner for any new attack, or when there's a new emerging type of malware, they are able to monitor and also to really single out quickly and to patch it quickly, to work together with the tech IT specialists in order to increase a lot more scrutiny around also the coverages that being provided with, and also to be more focused on the type of coverages, to strip out the non-core coverages, for example, and also to sublimit if there are any non-core coverages, and also maybe to increase a lot more scrutiny around maybe the non-IT business interruptions type wordings, for example. I think these are definitely coming.
So again, Sie, thank you so much for sharing your knowledge and what you're seeing at the market. We are definitely gonna catch up with you once we see how the dust settles from COVID, I guess later in the year 2021 or maybe in 2022. And until then, again, thank you so much.
Pleasure. Thank you for having me again, Danny.